So today, last night actually, we had earnings from both Microsoft and Alphabet. I think people know that one of our themes here at Crescat and our long, short, and global macro funds is we're pretty bearish on the Magnificent Seven, on mega cap tech stocks, and really, a number of these names had really started to roll over, really going into last Friday, a week ago, when I think Nvidia had lost several hundred trillion of market cap in one day alone, when it was down. What did I say? Several hundred billion of market cap in one day alone, when it was down, 10%. But there's a lot of excitement about Microsoft and Alphabet's earnings today, because they beat on revenues and earnings, and both of them showed growth in their cloud business. This is what competes with Amazon Web Services, with all of the frenzy and spending going on in AI right now. Cloud is a booming business, and Microsoft and Google have always been trying to compete with Amazon in the cloud. They've been number 2 and 3. It's my contention that Amazon is going to be much more competitive than these two companies. And these are monopoly companies. I'm talking about Microsoft and Google and their respective businesses that are used to very fat margins and in their advertising and search, and in the case of Google and Microsoft with its operating systems and Office products. So going into the cloud is a new thing, and they are benefiting from all the spending in AI right now, and that's great. And they're showing some growth, but they're also showing is huge investment in CapEx. That there is no guarantee that they're going to get a return on this investment, especially going into the cloud and trying to compete with Amazon. Now look at the free cash flow estimates on both Microsoft and Alphabet, and this is after today's earnings. This is the free cash flow estimates for and Microsoft's got a June fiscal year, so it's like June 2024 and June 2025, and you can see that after the earnings came out, the estimate is going down for free cash flow for next year. Not only that, the estimates have been coming down for 2 years straight already, and it's not getting any better. Same thing with Alphabet. Look at it. Look at how the estimates came down again for Google's free cash flow. To be fair, Microsoft did beat on free cash flow this quarter. But the analysts were looking for a negative year-over-year comparison, and they actually had positive. But look how these estimates have been coming down since the market peak at the end of 2021, and the valuations of all these Magnificent Seven, collectively have gone to new highs at the same time as the fundamentals have improved in the short term, but the outlook, especially on the free cash flow side of things, does not look good, and the valuations are still stretched as can be. Let's go on to the next. We've updated this chart here to show the enterprise value relative to GDP of the top 10 tech stocks. And I know we showed this chart many times, and I'm going to keep showing it. I'm going to keep updating it, because I think we have hit that double top peak already. I think we're coming off of it now, and Google is the only Mag 7 stock that's at a new all-time high right now, and many of the others have rolled over already. Yes, we're seeing a good reaction to the earnings. I think it's a big, of the two stocks I just mentioned, I think it's a big head fake. We'll see. We'll see going into next week. I want to say, one other thing. The whole concept about this chart really is to say that when you have such incredible market share and valuation relative to the entire economy, and now you're a target of antitrust legislation and competition disruption from artificial intelligence itself, and like we were showing with the free cash flow, these companies are having to increase their spending, so the growth is decelerating across the board, but all of these companies collectively are trading as if they are going to grow faster than the economy, but they're priced collectively as if their market value is implicitly pricing that all of these companies collectively are going to be able to grow faster than the economy, and it's just impossible because these companies are the economy. What we showed, how they peaked out at the peak of the tech bubble in 2000, based on a similar indicator. When we came down in 2023, all that we did was retest the top of the tech bubble level, and here we are back up again at the 2021, high valuations. I still contend this is a large cap bubble that we're in, and I believe it's ready to roll over. Let's go on to the next. So what are some of the other indicators that this is ready to roll over? Well, cash flows. Look at how this is the B of A fund manager survey. Look at how money manager cash levels are as low as they've been since that late 2021 market top, and other than that, it's the lowest they've been in 10 years. Go on to the next. Positioning. Here's looking at futures, equity futures positioning by asset managers. It's above 2 standard deviations in terms of net long positioning in U.S. equity futures that they've ever been. So these are contrarian indicators. When cash is too low, where's that cash to come in and buy more? You're much more likely to have to sell if the fundamentals start to turn down. And so same thing with positioning on the future side. Let's go on to the next. Here's short interest on the SPYs and the Qs. As relative to shares outstanding, short interest is the lowest it's ever been. People are afraid to be short the large cap indices. Let's go on to the next. These are contrarian indicators. So as you know, we have a big long theme on the precious metals side, including electrification metals as well. This is looking at the Barron's Gold Mining Index to gold ratio. And so what's the Barron's Gold Mining Index? So Barron's, going all the way back to like the 1930s, used to publish industry indices all the way up until like 1980, and maybe even the late 80s. And somebody purchased a license to their database and has continued that series, and it's called Gold. The guy's, his name is Nick or something like that, and he runs an outfit called Gold Charts Are Us, GCRU. Look it up if you want to get the data. It's actually pretty cheap. But the reason it's important is this Barron's Gold Mining Index. It goes all the way back to the 1930s, and you can look at the gold stock index back to the 1930s. It's incredible data, and look how cheap gold stocks are. And so this guy Nick has continued the series to this day, and you can't find the data on Bloomberg, or you have to go to him directly to get it. But look, we are gold stocks are the cheapest effectively that they've been relative to gold itself, since the 1960s, before that huge run up that we had in the 1970s. Let's go on to the next. Similarly, we're focused here at Crescat on exploration stocks, and similarly to that larger cap Barron's Gold Mining Index relative to gold. There's a junior mining index that we use, and it's actually a proxy for junior miners. That's the TSXV composite, and it's a proxy for junior miners because it's something like 67% of the companies that are in this index are junior mining stocks, and it's the TSXV index, and the TSXV exchange. There's actually a couple thousand stocks that are listed on the TSXV exchange, 1,900 companies to be precise, and 51% of those are mining stocks, so junior mining stocks. There's like 120 some companies in this TSXV composite index. 60+% of them are mining stocks, and the average market cap is a couple hundred million. And in this bigger index, you have to be in the top 0.2% of the broader exchange, this TSXV exchange, to be in the index. That's the criteria. If you look at the average market cap of the mining stocks that are in the bigger TSXV composite, it's like $29 million average market cap. So I mean, this is our universe of public explorers. There's also junior mining companies listed on the Australian exchange and other exchanges like the Canadian Securities Exchange. But TSXV, the venture, is really the proxy that we can use. And so what do we see when we look at the TSX Venture Exchange Index? I mean, gold has been hitting new all-time highs. This index hit its prior high in US dollar terms of 3,400 plus in 2007. And I can't, you have to do your own math in your head to see, how many times higher it is compared to the $412 per share that it's trading today. But hint at something like 7 times. But look at where gold is hitting new all-time highs. Look at how depressed the exploration stocks are relative to their prior highs. This is similar to that Barron's chart that we're showing. We're just focused more on the junior explorers. The value opportunity in junior mining companies today is extraordinary. But there's a lot of companies. One really needs, we think, expert guidance in order to know which ones to focus on, and that's what we're about with Quentin's expertise.